Hello everyone, welcome to the EPS/EBIT lecture out of Chapter 8 in the Strategic Management book. Okay, so I'm just going to encourage everyone as I do this to follow right along with me. I'm going to give you all the formulas, everything you need to do to recreate what is on Table 6 in the book. Table 8-6, the EPS/EBIT analysis for Boeing. I'm working out of the 15th edition, but this is identical, the EPS/EBIT analysis for Boeing in the 14th edition as well. And so I'm going to work through this and show you how to get all of those numbers so you can recreate this over and over and over again. So the first thing we need to do, and I'm going to assume everybody's looking at the analysis for Boeing in the book as I'm working through this. And I'm going to show you where to get each and every number. So first, let's go to the amount needed. First thing they give us is the amount needed. Now it's nice and handy for the sample problems when they give us the amount. And the amount needed, and just pardon me as I play with my Excel sheet to make things look good, is $10 million. So I'm going to do everything here as the book does. I'm just going to do it like the book does so things look the same. So it looks like 10,000, but it's really more than that. So where does this number come from, the amount that they need? Well, in many cases, the book will give you the amount you need. In real life, you're going to know exactly what the amount needed is. But if you don't have either number, where do you start? Well, my advice would be to start with the normal EBIT for a company. So if you look under common stock financing and you go across from EBIT, you see the normal amount is $2,500. So 4 times that is about 10 million. It's 10,000. I'll just refer to the numbers as they appear. So the normal amount is about 10,000. That's about 4 times that amount. That's a good rule of thumb on where to start for this academic exercise. Now you say, where do I get the EBIT? Where does that number come from? Well, let's hop over here to Yahoo. We're going to go to Yahoo Finance. And I'm going to go to quote lookup over here on the right. And the stock ticker for Boeing is BA. So I'm going to go to Boeing. To get to the EBIT number, earnings before interest and taxes, I'm going to go to financials. And under income statement, where it puts me, I'm going to scroll down. And I got the number right here, earnings before interest and taxes. Now, as you can see, the number that I have here online, 7430, is much bigger than the normal number they give me in the book, which is 2,500. They've been using this example for a long time in the book, so I think this is probably pretty old. So if you were going to do this for current numbers, and you could see here that we have 2015, 14, and 13 data. So if you were trying to do this for a recent company for one of your exercises, you were trying to estimate what your amount needed might be, you'd go 7430 times 4, which is about 30,000. So that'd be a nice place to start. This is just an exercise. This whole thing is an exercise in learning the process rather than have the product. It's to understand how all of this works. In real life, if you were ever going to do anything like this, you would have accountants and financial experts do it. But this is just to help you with understanding of what's going on. So that's where, if you don't know where to start, where to get that amount needed, go through the process I just showed you. We're not going to use these up-to-date Boeing numbers. We're going to use the ones in the book, but I'm going to show you where you might have gotten them. So let's pop back to our Excel sheet here. And so that's where we get the amount needed. Now, interest rate. Where do you get interest rate? Well, this is just the current cost of money. It's your current cost of money. So I think at this point in time, 5% is about right. interest rates are at all-time lows. If a company is going to take out an equity interest rate, it's about 5%. If you don't know what to use, 5% at this time is just fine. So I'm going to turn that to an interest. I'm going to push the little percentage button there, make it look like an interest rate. Tax rate. Now the tax rate is a little bit more complicated. Tax rate is a little bit more complicated to figure out. The book gives us 7%. If you're given the tax rate, that's fine. But if you are not given the tax rate, you may want to go ahead and calculate to see what that tax rate might be. So if you want to know what the tax rate for a company is, simply go back to the Excel sheet, and right here, where you see my cursor, you have income before tax. And then here you have your taxes, your tax expense. Okay, so you're going to take this number and divide it by this number. So you would take 1979 and divide it by 7155. And you would end up, I believe, at about 27%. And that would be the tax rate you would use for your exercise. In this case, they give us the tax rate is 7%. I'm not sure where they got that originally. I mean, maybe obviously Boeing paid 7% in tax a long time ago when they put these numbers together. But I want the numbers that we do here in the sample to match the book so you could see exactly where I got all those rather than using these current numbers. But that's where you'd get the tax rate. Once again, so you'd take your tax expense and divide it by the income before tax. So let's hop back here to our Excel sheet. And we're just going to put in the one the book gives us. But once again, I just showed you how you would calculate it if you needed to. Stock price. Well, the stock price is given to us at $53. I'm going to turn this to dollars. But where you would get that, once again, if you're on Yahoo Finance, go up to the top, and that's this big number right here. So today, Boeing's at 152.16. Back when they did this, Boeing was at 53. So we're going to use the 53 number, but this is where you'd get the number right there. And number of shares outstanding. So as you can see from the book, number of shares outstanding. Move this over just a little bit. That's 826 million shares. Once again, where do you get that number? Well, I'm going to go back here to Yahoo Finance. And you can see I'm in financials. I'm going to hop over here back to statistics. And I'm going to slide down. And where is my number here? I think I passed it. There it is. Shares outstanding. So that's the current number of shares outstanding, 617.17 million. The book gives us 826 million. Once again, old data, but that's where you'd find the number. Okay. If you go under statistics, go under the stock, go under statistics, and then you have your shares outstanding number. There's a lot of different ways to find that. That number, but that is the easiest in my opinion. So let's go back to our worksheet. So now I'm going to work through all of the different methods of the common stock financing, the debt financing, the 70-30 and stock to debt, and 70-30 debt to stock. So let's start with common stock financing. And I'm going to show you how to recreate what they have done here in Excel. So we have EBIT, interest, EBT, which is earnings before taxes. This is taxes. EAT, which is earnings after taxes. Shares, and earnings per share. And if you're on any of this, if you need to stop or slow down or hear anything again, make sure you just go backwards a step and replay it or pause it to see the formulas as I go. For the sake of time, I'm not going to leave the formulas open. I'm just going to rely on you if you see a formula you want to just pause the video so you can see it. All right. And then up here, we're going to have recession, normal, and boom. Okay, so first of all, what are we trying to accomplish here? And what we're trying to do is say, we have a company, in this case Boeing, that needs to raise, actually it would be, what is it, $10 billion? Because that's in millions. So Boeing's trying to raise $10 billion. And these are the different options that we are considering. Once again, it would be a little different in real life. You'd hire professionals to do this, but just so you understand the process. And we're trying to figure out what would be the best way to come up with $10 billion. Do we want to sell more stock? Of course, if we sell more stock, we dilute the value of the stock. But it would get us money pretty quick. Do we want to borrow the money? That would be pure debt financing, just borrow. Do we want some sort of combination of borrowing and selling more stock? And then how do we account for the economy? And that's what this is. So we're going to come up with 3 scenarios for each option. So what if there's a recession? What if things are normal? And what if there's a boom? Where do we want to be in each situation? So we're going to start with normal. And once again, we talked about this number already. Where do you get it? Typically, the EBIT is in the financial statements. You would know this. So we're going to use the one that the book gives us, which is 2,500. The recession is 1,000, and the boom is 5,000. And we're going to use this, the earnings before interest and taxes. This isn't going to change based on which option we are pursuing. It's going to be the same for all of them. The interest. So where does the interest come from? Well, in this case, we're not borrowing any money. So we're not borrowing anything, so interest doesn't apply. We're just selling stock. So our interest is going to be 0 for all of these. Next, we're going to have our earnings before taxes. And what this will be is our earnings before interest and taxes minus interest, which gives us earnings before taxes because we've accounted for interest. So it's going to hit enter there. And of course, it's going to be the same because 1,000 minus 0 is 1,000. Then I'm going to slide this across. So I only have to type everything in once. My personal preference is always to type in a formula once and slide it across because that way you lessen the risk of more typing errors. Taxes. So what are we going to do for taxes here? Well, I'm going to set up this worksheet to make it easier as I go so I don't have to retype everything for every option. So what I'm going to do is I'm going to multiply our earnings before taxes times our tax rate, which is up there at 7%. So I'm going to go equals, and I want to lock in the tax rate cell. So I'm going to go equals B, $B, $5. And it highlights it up there. So that means no matter where I am in this Excel sheet, this formula will refer to that exact cell. So I got $B, $5 times, and then I always want to multiply it times the cell right above it. And I do want that to change as I slide it across. So I'm just going to click on that cell, or you could type it in and get B13. Okay, I'm going to hit enter, slide it across. Now that should match the numbers in the book. So now we have earnings after taxes. So this is earnings before taxes, so we're just going to go equals B13 minus B14. That'll give us 930. Slide that across. Once again, these should all match the book. Now the number of shares is a little tricky, and this, judging by questions I have received, can trip some students up. So in this case, what we want to do is we're going to take our number of shares outstanding, because what we're going to add enough shares to come up with this number up here. So we need to, how many shares do we need to sell to come up with this amount of money? So we're going to have more shares in circulation. Once again, we're going to dilute our shares. So first thing we're going to do is I'm going to go equals $, what's my cell up there? Shares, 826. So I'm going to go $B, $7. And I'm going to add to that the number of shares I need. So that's going to be $B, and that's 3 right there, $3. So it's going to be this number over here. And then I'm going to divide that, because that's how much money I need to come up with. I'm going to divide that by the share price, $, $B, $6. I apologize if it seems like I'm going a little slow. I'm having to think as I go here, so I want to make sure to get it right. So $B, $7, so that's 826 plus 10,000 divided by 53. So that's going to be how we would finance everything by just selling more stock. Okay, so the number we get, 1014.67925, which is the same as the book after we adjust it a little bit. That's the wrong button. So I'm pushing this little button up here. That's going to get me to 104.68, and then I'm going to drag that number over. Okay, and then earnings per share. That's going to equal your earnings after taxes divided by your number of shares. And once again, I am going to reduce that to 2 spots after the decimal point, slide it over, and that's your earnings per share. And that should all match the book. Yeah, I'm checking there, it does. Okay, so that's how you fill out the chart. Once again, if you need any of those formulas again, just go back into the video and pause it. All right. So let's move on to debt financing. Debt financing. What I'm going to do here to save a little time is I'm going to copy and paste everything we just did and then make changes to it. That will save us a whole bunch of time. So these numbers stay the same. And now we're going to have interest expense because we're going to borrow all the money for this. So our interest rate, or the amount of interest we're going to spend, is going to be the amount of money we're going to borrow times the interest rate. So I'm going to go equals $B, I wish I should remember these, B3 times B4. All right, so I'm just going to enter that in. $B, $3 times $B, $4. And that's going to give us 500. I'll follow that across. Actually, I'm going to change these to dollars too, just because it looks a little better. And then our taxes, I guess this is all. We don't have to convert it like this, but I do think it looks a little bit better. Okay. So our earnings before taxes are going to be 500. And as you can see, if you look over at the debt financing in the book, you see all these numbers work. So we don't have to redo any of these cells because the way we had it set up the first time, all those formulas still hold true. Where we get into trouble is number of shares. Here we expanded the number of shares we were offering because up in the other example, you could see that that's how we paid for everything. Well, we're not selling any extra shares because it's 100% debt financing, so we need to convert all of these back to 826. So we'll convert those to 826 because we're not using that method. And then the earnings per share, everything, as you can see, just works. All right. So that's debt financing. You can see once you do the first one, it gets a little easier. So let's move on to 70% stock, 30% debt. I'm going to take this same block here. I'll make one change in a minute. I'm going to cut and paste it down below. So we're going to see that we need to make some subtle changes here because we are going to make sure I'm doing this in the right order. 70% stock, 30% debt, right. So this formula here, the interest, we are going to finance 30% of it through debt, not the full 100%. And the formula we have up here, and I'll just double click here and give you the formula. For interest, this is financing all 10,000 through debt. Now we're only going to finance 30% of that. So what we want to do is multiply this number times 0.3. So that's just 0.3 times 0.3. So that's because we want to take 30% of that number. Hit enter, then take that and just slide it over. So it should be 150 across the board, 30%. And then you can see, going by the book, that these other numbers fall right in line. Okay. Then we get to shares. Now, we're financing 70% of this through shares, through stock. So I want to make an adjustment here. So rather than retyping all the formulas we did before, I'm going to go back up to my common stock financing and steal these formulas so I don't have to retype everything. So I'm just going to highlight those 3 rows, copy it, and paste it right here. Now we're still going to get these numbers, but now we know we're going 70% stock. So what we want to do is go up into our formula. I'll double click into the formula. So this is 826, which is B7, plus, and this red number here is our 10,000 number. So we want to finance 70% of that through stock. So I'm going to just multiply that by 0.7 and hit enter. And then slide that across. And now the numbers should match the book for that one. Okay, so we adjusted the interest for 30% and the shares for 70%. Now we're going to do the inverse. So I'm going to just take this whole block right here, copy it, and paste it right below, and just change these 2 numbers. I'm going to change this to a 3 and this to a 7. So it's 30% stock, 70% debt. And all I have to change is the 2 changes I made on the previous one. So in this row here, I have this set, let me do it on this formula. This is set for 30%. I'm just going to change that to a 7 and then slide it across. And then down here, I have this set for 70%. I'm just going to change that to 30%. Slide it across. All right. So now we've done all 4 just like the book. All the numbers match perfectly. At least I hope they do. And so now we have a decision to make. How should we finance common stock, debt, 30-70 split, 70-30 split, based on recession, normal, and boom? So what we're looking for is the highest earnings per share for each option. So if we're looking at recession, we start here 0.68, 0.83, 0.56, and 0.92. 0.92 is the highest. So we want to do, in a recession situation, we want to be in common stock financing. For normal, 229, 225, 228, 227, we want to be up here 229. Once again, so common stock looks the best. And for a boom situation, 458, 507, 471, 490. So we'd want to be here in debt financing. So those are the three situations you want to be in. Common stock for recession and normal, and debt financing for a boom. And that is the earnings per share / earnings before interest and taxes analysis. I know this is a lot of information, a lot of Excel work in a short period of time, but like I said, pause it if you want to see the formulas, and hopefully this will help you with this type of analysis.